All right, so this is Bryant Sikorsky. I'm a financial planner and wealth advisor with Stratos Wealth Partners. It is 6 o'clock on the dot. We're going to get started to respect people's time. We will be done in no more than about 35 or 40 minutes. You can see on the screen here our topic today is wealth planning strategies for business owners. And you see below there my name, Bryant Sikorsky, accredited asset management specialist, which means I've taken on additional training certification for portfolio design, and CRPS, Charter Retirement Plan Specialist, which means I've done likewise for company-sponsored retirement plans. As a financial planner and wealth advisor, I typically help individuals and business owners make good financial decisions with their money. That includes planning such as financial, retirement income, insurance, education savings, planning, implementation, and investing such as stocks, bonds, mutual funds, life, disability, long-term care, and then ongoing client service and education such as something like this, which we're going to cover today. For both, we have some clients and we have some non-clients on this webinar. So if we think about business owners and businesses, and when we consider the challenge and the complexity with establishing, managing, and growing a business, owners often neglect to focus on key issues associated with their personal wealth. So we're going to explore a range of areas to highlight issues and present potential solutions for business owners to consider. So here are our 4 topics for discussion today. Number 1, tax considerations. Under the new tax law, we'll examine a significant change in the tax code introduced by the Tax Cuts and Jobs Act, a new 20% tax deduction for qualified business income, or QBI. We're going to look at ways to shield assets from potential creditors. So business owners who are uniquely exposed to creditor risk via potential claims or actions from other partners, employees, customers, or other business relationships. We'll look at some potential planning strategies owners may want to discuss with their legal counsel. We're going to talk about saving for retirement, as business owners are often laser focused on growing their business. A regular retirement savings strategy may be neglected, and we'll discuss different retirement plan options for clients and tax credits available to defray those startup costs. And finally, planning for succession. I thought this is really interesting that 60% of older generation owners plan to transition their businesses over the next 10 years. However, more than half do not have any type of formal succession plan in place. Focusing on business succession now can increase the current value of the business, establish financial security in retirement, provide for family members, and minimize taxes through efficient transfer of wealth. So let's start by discussing tax planning considerations for small business owners. So number 1, most businesses in the United States are not large corporations, but rather structured as pass-through entities such as S-corps, LLCs, partnerships, and sole proprietorships. While the marginal tax rates for individuals and couples apply with a maximum of 37%, many of these businesses will benefit from a new 20% deduction of their business income. The new law establishes a 20% deduction of qualified business income, QBI, from certain pass-through businesses. Now, specific service industries such as health, law, and professional services may be limited to claiming this deduction depending upon their income. A late change in the legislation removed engineering and architecture professions from being considered specified service businesses. And God only knows what Congress, right? The law establishes a 20% deduction of qualified business income, or QBI, from certain pass-through businesses. Specific service industries such as health, law, and professional services are excluded, but not engineering and architecture at certain income limits, fully phased out at $210,700 in income for individuals and $421,400 for couples. However, joint filers with income below $321,400 and other filers with income below $160,700 can claim the deduction fully on income from service industries. This provision is currently scheduled to expire on December 31st of 2025. So here's a detailed flow chart showing how the deduction applies depending on the characteristics of the business. So here's an example of how the deduction for QBI would apply for a non-specified service or trade business, SSTB, when income is higher and the alternate test applies. So here are some thoughts on how to maximize the deduction for QBI. We can manage or reduce income to avoid income phase-outs. So strategies to reduce taxable income, such as contributing to a retirement plan or health savings account, may allow a business owner to benefit from the new 20% deduction by avoiding phase-outs at certain income levels. Other strategies around realizing or deferring income, such as timing of invoices, tax loss harvesting, careful recognition of capital gains, may also aid in managing the amount of taxable income. For example, consider a self-employed owner of a specified service trade business, or SSTB, who reports $180,000 in net business income. The QBI deduction begins to be phased out above $160,700 for single filers in taxable income. If the owner contributes 20% of net earnings, or $36,000, to a SEP IRA, this will lower taxable income to $144,000, and the phase-out of the deduction will no longer apply. Additionally, business owners may be able to reduce income through realizing expenses. The Tax Cut and Jobs Act enhances expense recognition for business by increasing the 179 deduction and providing bonus depreciation for the next several years. Through 179, small businesses can expense the full purchase price of certain qualified income or property, including used equipment, in that tax year, instead of capitalizing the cost over several years. The deduction applies to tangible property used in a business, such as computers, office furniture, manufacturing equipment, and qualified real property. The amount deductible is increased to $1 million a year in 2019 from $500,000 in 2017. Total equipment purchase cannot exceed $2.5 million, as a phase-out applies above that amount. So let's shift our conversation to risks associated with potential creditors. So let's start off by looking at the headlines, specifically some lawsuits that made the U.S. Chamber of Commerce's top 10 most ridiculous lawsuit list. So we have one where a man trips over a Christmas tree and sues. The New Jersey man is suing the owners of an apartment complex for injuries he claims he suffered because of a recklessly, carelessly, and/or negligently discarded Christmas tree that caused him injury. The negligent handshake leads to a lawsuit between lawyers. Two Florida lawyers are meeting in court because of a handshake that one of the attorneys claims left him in severe pain. Women sues restaurant after falling off popular donkey statue. In August 2015, Kimberly Bond visited the El Jalisco restaurant in Tallahassee, Florida and voluntarily climbed up on a donkey statue, which she says was smooth and slick, causing her to fall. A Massachusetts man files class action lawsuit over fake butter. Joe Polnick of Worcester, Massachusetts, claimed he ordered a bagel with real butter at Dunkin' Donuts and filed 2 lawsuits, including more than 20 Dunkin' Donuts franchises in the state, of putting a butter substitute on his bagel when he ordered real butter. And finally, woman sues U.S. government over nacho cheese burn. A woman from Wichita Falls, Texas, is suing the federal government after she alleged a bowling alley employee at Shepherd Air Force Base spilled hot nacho cheese sauce on her finger. She claims that the cheesy injury, I don't know if that's a noun or an adjective, resulted in restricted work hours and ultimately in the losing of her job. So, one of the first steps in the asset protection process is an analysis to determine what is potentially at risk of being attached by a creditor or lost in bankruptcy proceedings. During this presentation, we'll hone in on what assets may be considered protected from creditors. A good asset protection plan will explore strategies to increase this area. During today's discussion, we'll begin by discussing some basic techniques such as umbrella liability insurance or homestead protections. Then we'll delve into more complex areas such as limited liability companies. Any business owner who may be at risk of litigation by patients, customers, or employees should consider protection from claims against the business. Without a formal business structure, personal assets may be at risk due to a legal claim against the business. The idea is to structure business ownership to make it difficult or expensive for someone to access your assets. And we will explore several options in more detail. So consulting an attorney to determine which option is appropriate based on the business and prevailing tax laws. So there's several options a business owner may choose to provide a measure of protection. For example, you can form a corporation such as a C Corp or S Corp, or opt for limited liability company, LLC, or limited liability partnership, LLP. Because LLCs and LLPs are considered separate legal entities, assets held within them are not deemed to be owned by the individual. Therefore, a plaintiff seeking access to the individual's assets will need to pursue the LLC or LLP and not the business owner individually. LLPs and LLCs are generally less complex to establish and maintain. For example, compared with corporations, there are not as many qualified formalities such as directors' meetings, written minutes. Additionally, LLCs and LLPs may provide superior protection depending on the state, since the legal remedy for a judgment against an LLC member or limited partner is a charging order. This means the ownership interest in the business is protected. The plaintiff does not acquire the actual asset, but is just entitled to any distributions, though not necessarily the case for a single owner LLC or LLP. So this may provide more favorable settlement terms in the event of a lawsuit. It's important to note that state law will vary widely when it applies to the level of protection an LLC structure may provide. So again, it's important to consult a qualified attorney with specific knowledge of state law. I will tell you, for my own personal perspective, I do have errors and omissions insurance as a financial advisor if I were to make an error in a financial transaction. I have my company formed as an LLC. I have an umbrella policy which covers any lawsuits above and beyond what, say, my homeowners or or auto policy would cover, and I have a trust where my cars and house and non-retirement accounts are named, so they are separate and distinct from me. So here's again another example, just like myself here, but here is a visual example of how doctors in a private practice might consider using LLCs to strip equity out of the practice and segregate potential liability exposure. For example, if there's a lawsuit or judgment related to the real estate, that legal claim will not impact the medical equipment or the medical practice itself. So essentially you can see that they're setting up separate companies and then creating a leasing agreement with the third from the medical practice. So there's a, I don't know if you want to call it kind of an arm's length transaction there. I mentioned the use of LLCs to own real estate can be an effective strategy. So here's an illustration to elaborate on this approach to, in particular, establishing and maintaining numerous LLCs. So let's assume a high net worth client owns several properties in addition to personal assets such as their house and savings accounts. Owning real estate carries with it the risk of a negative episode occurring at that location. Although it may be impossible to completely eliminate the risk a real estate asset poses, the LLC strategy can at least contain that risk within that particular asset. And this prevents other benign assets, such as personal bank accounts, from being contaminated due to an event affecting a real estate holding. In this case, the client owns several properties and should consider establishing multiple LLCs, one for each business asset. This way, the risk of each property is contained to that particular asset and cannot spill over to personal assets or other real estate holdings. For example, let's assume an event such as a personal injury occurs at the commercial real estate property, which leads to an attachment to a creditor or judgment to a plaintiff. That creditor or plaintiff would be limited to targeting the equity associated with the commercial real estate property, not the personal assets, the rental property, or the apartment building. It may be more complex and expensive to create and maintain three separate LLCs, but the added benefit of risk containment may be worth the extra effort. Also, some states allow the use of a master LLC, sometimes also referred to as a series LLC, to facilitate certain activities such as tax filing. The master LLC is established as a sort of umbrella LLC over others. An example of this scenario is a company that owns, excuse me, my screen just flipped here. This is a scenario of a company that owns 10 different taxi cabs and wants to establish a separate LLC for each one, but also wants to streamline any tax filings that would roll up under the master LLC. Continuing our discussion, let's talk about business owners and preparing for retirement. To promote increased participation in workplace retirement plans, the federal government offers a tax credit to certain smaller businesses to help defray startup costs. So here are the details of the tax credit. So we can see here a credit of 50% of your ordinary and necessary startup costs to a maximum of $500 per year for 3 years. So this could be used to offset the cost of starting up a new company-sponsored retirement plan. So as business owners devote so much time and effort to managing their business on a daily basis, retirement savings is often neglected. Here's a comparison of several types of retirement plans which are available. We have here the Simplified Employee Pension, or SEP IRA, which is really kind of like a direct benefit plan, almost like a pension, in which the company deposits money into an employee account. We have a savings incentive matching plan for employees, or a simple IRA, where the employee gets to defer income and the business provides a match to that contribution, or a non-elective contribution. And then a 401k, which is very similar to the simple IRA, with the change being, you notice that it has higher contribution limits, such as 13,000 plus 3,000 for over 50, for a total of 16, versus 19,000 for an employee plus 6,000 if over the age of 50. The other key piece is the 401k does offer additional features such as loans and an ability to customize plan designs to meet very specific needs, which the simple does not offer. While one goal of providing a retirement plan is to attract, retain, and compensate employees, business owners must not neglect their own retirement savings strategy. This is especially critical since many business owners often put off savings for themselves while instead plowing more funds towards maintaining and growing their business. In fact, research suggests that only 18% of small business owners participate in 401k plans, and many sacrifice personal savings in order to continually invest in their business. Business owners looking to fund retirement may see opportunity with certain types of profit-sharing strategies. One in particular, referred to as a new comparability or cross-tested profit-sharing design or plan, allows the employer to direct a greater percentage of profit-sharing contributions to themselves. These plans allow employers to divide employees into different groups and then calculate contributions on certain factors that benefit the business and the business owner. The cost and complexity involved to establish and maintain this type of plan may be a little more than a standard 401k or profit-sharing combination, but in many cases, the extra cost can be justified with the higher percentage of contributions allocated towards the owner. With a simple low-cost retirement plan like a SEP or IRA or simple IRA or 401k plan may be appropriate for business owners, some who wish to fully maximize the amount that can be funded on a tax-deferred basis can take a look at what's known as a cash balance plan, which operates like a defined benefit pension plan, but has some characteristics of a defined contribution plan. Like a defined benefit plan, the employer funds the plan and retains all responsibility, including risk, for investment management. The plan provides a standard retirement benefit for participants based on their age and work history. Like a defined contribution plan, the plan maintains separate hypothetical accounts for participants. And upon retirement, participants must be offered a lifetime income option through annuity payments. Many plans will also offer a lump sum option so funds can hold tax-free into an IRA. Cash balance plans may be attractive for highly profitable business owners who are looking to accelerate their retirement savings over a short period of time. Unlike a 401k profit-sharing combination where an applicant could save roughly $50,000 to $60,000 a year, a business owner, depending on their age, may be able to defer more than $200,000 a year into the plan. The plan uses a defined benefit formula to provide an annual benefit that cannot exceed the lesser of 100% of the participant's average compensation for the 3 highest consecutive calendar years, or the 415B1A limit of $225,000. The formula to get there can include years of service, salary, and an assumed interest rate. The actuary then tells you what the present value contribution is in order to keep the plan funded within an allowable range. Because of the complexity of the plan design and the need to make actuarial calculations, these plans will generally carry higher expenses than a 401k plan. And also, business owners have to be committed to funding the plan on a regular basis. Where I see this also being implemented is in those types of circumstances where a business owner perhaps had to attend and complete many years of college or residency or internship, such as attorneys or CPAs or physicians or others in the medical field. And by the time they have a couple nickels to start saving, they might be well into their 30s or even 40 years of age. And this is a great way to really accelerate that savings strategy. Lastly, let's spend a few minutes covering some important aspects of business succession. First, business succession is challenging. Most of those with no plan, or 78%, blame their lack of planning, at least partially, on enjoying managing their company too much to start thinking about a future transition. 42% said they were too busy to plan, and 44% felt that succession was too far in the future to need to establish a plan now. The bottom line is, without proper planning, most businesses won't survive past the original owner. And we see statistics like only 30% of businesses have a formal succession plan, 30% of family businesses survive the next generation, but only 12% into the third and only 3% into the fourth. Pretty dire numbers there. Here's an example of how a succession planning process may look like. The first step is defining goals and getting organized. Make sure records related to operating the business are in place and updated. Operations and systems manuals and processes, training documents, financial records, competitive analysis, partnership or shareholder agreements, review contractual agreements such as leases, plans for intellectual property, and patents. 2, a thorough financial analysis of the business, including balance sheets and income statements. How much is the business currently worth? As an owner, what is the business owner's cost basis in the business entity? 3, define potential options for transitioning the business. Are family members, partners, or key employees a possibility? Does a sale to an outside party make sense? Is there an opportunity to transfer ownership over time to employees via an employee stock ownership plan? Consider what you want to get out of the deal and what your successors are or might be looking for. This is particularly relevant if members of your family will be taking over the business. Are you leaving the business entirely, or are you planning to work part-time? Are you considering bringing in someone else to run the business while you still own or part own it, or are you looking to sell out completely? 4, how should the sale be structured? For example, half of business owners sell to family or employees, so not surprisingly, installment sales and earn-out agreements are the most prevalent types of transactions. Is there an opportunity for a stock transfer that may have certain tax-related benefits in deferring capital gains? 5, depending on the nature of the sale, transition family members, employees, partners, or an outside third party, there are a variety of wealth transfer strategies that can be considered to ease transfer and mitigate taxes. For example, business succession within a family may benefit from a sale of business interests to an intentionally defective trust. Ooh, we'll discuss that in a minute. What in the world is that? Lastly, clear communication throughout the process is most definitely critical. So, as part of the succession process, access to experts is critical. So here's a visual including many different types of experts and specialists that can provide value during the process. Most business owners hopefully have a financial planner, an attorney, a CPA, and perhaps some sort of finance, like an accountant or bookkeeper relationship already in place. Depending on the nature of the business transition, other specialists, such as an investment banker, may be needed. Also, it's important that these specialists work together as a team and not disparate functions, not communicating or coordinating with each other. So one of the most important components to successful business succession is business valuation. There are different methods a seller may consider, and in some cases it may make sense to use a combination of several approaches. First, using a market comparison to determine fair market value, kind of like what you would do with your home. Based on a price a willing buyer and a willing seller would agree upon with mutual knowledge of all the relevant facts. And this is one option that might apply. This approach may prove challenging since unique businesses or service models may make comparisons very difficult. If the business being sold is basically similar to other businesses of its kind, like dry cleaning, the market, for example, the market approach with some adjustments may be appropriate. However, applying the market value approach in the real business world may be difficult to find an apples-to-apples comparison. Another method to determine a value for business is to use a multiple of earnings. With this approach, you simply multiply earnings of the company by a specific factor, such as 3 times EBITDA, or earnings before interest, taxes, depreciation, and amortization. For example, you might multiply your annual revenue by 3 in order to come up with a value for the business. The multiple that you use can vary significantly from one business to the next. So typically a common multiplier will be used for an industry and type of business. By using the discounted cash flow model, you can calculate how much cash flow the business will create over a period of time. Then you use an expected rate of return, such as the rate of government treasury bills, to calculate how much money you would need to invest to earn that rate. This method has become some subjectivity to it, since the valuation specialist will have to determine an appropriate discount rate, which we'll cover in just a minute. Lastly, a simple way to estimate a value for your business is to simply look at its assets. If you were to buy everything the business owns, how much would it cost? Look at the total company assets and compare them to the liabilities. The difference between these assets and liabilities represents its current asset value of the company. But remember, this method doesn't take into consideration the goodwill that you may have built for your business, which will have an effect on future earnings, nor does it factor in your market share, which may well influence the true value of the business. The income method applies a discount rate to determine the valuation of the business. So what's a discount rate? A discount rate is used to calculate the present value of future cash flows. This may be a better representation of the business's value for buyers who typically invest based on expected future cash flows. However, it can be difficult to objectively determine the appropriate discount rate, which is critical to the calculation. The valuation can vary dramatically based on the discount rate used. The higher the discount rate, the lower the valuation. So how do you determine a discount rate for a small business? Well, number one, start with a risk-free investment rate. What type of return could a potential buyer generate if invested in a treasury bond, for example, rather than the business itself? Add an equity risk premium. What could a potential buyer earn by investing in a broad equity market? Or consider adding a small cap premium. What could a potential buyer earn by investing in a broad range of small capitalization companies? And finally, adjust according to subjective factors, considering the brand, clients, recurring revenues, staff, market share, patents, or intellectual capital. Closely held businesses must plan for the transfer of ownership not just upon a sale, but upon an event arising out of one of the owners, such as a death, disability, retirement. A buy-sell agreement establishes a legal obligation for one party to sell and the other party to buy a business upon a specified event. Details such as what will trigger the agreement are included in this contract. A properly designated buy-sell agreement will specify the buyers of the business interest as well as the price or determine the process for evaluation. These types of agreements are typically funded with life insurance, which can provide liquidity for surviving owners to purchase the remaining business interest from family of the prior owner. This agreement also helps to convey to creditors, such as banks, that there is a plan for business continuity in place. In this chart, we feature a cross-purchase agreement where partner owners of the business buy and hold life insurance policies on each other. Some key considerations include surviving owners receive a new cost basis on the purchase of ownership interest from a prior owner based on the price paid at the time of transfer. Business valuation is key in order to make sure the plan has adequate coverage to execute the buy-sell transaction upon a triggering event. I remember a number of years ago, I had a builder as a client who I put a 401k plan in place for them, and I literally begged them to put a succession plan in place. It was just two guys. They were builders, had probably 20 employees, and were doing very well. They said, oh, we don't need any kind of plan like that. Nothing's going to happen to us. I literally begged them to, because of the line of business they were in maybe, to each have maybe disability insurance. So if one of them couldn't show up for work, they'd still get paid, or the rent would get paid in the business. And I asked them to put a succession plan in place that says, well, you know, what happens if one of you dies? You know, how, you know, who gets that ownership of the business? And, well, they said, oh, you know, that'll never happen to us. Well, guess what? It happened. And one of the two partners had a very severe heart attack and couldn't come to work. And so he was in the hospital, intensive care. And a week or so a week, 10 days went by, and the guy with the heart attack, his wife calls up the other partner and says, hey, where's my husband's paycheck? And the owner says, the other guy says, well, hey, he didn't come to work, he didn't get paid. And so she went to an attorney and went back to the business owner and says, hey, you know, if I show up for work, you've got to pay me. So she showed up for work in her, you know, yoga pants and her sweatshirt the next day, and the business owner had to pay her. Like, I don't know how she's going to build a house. And then unfortunately, her husband died. And so now there's no succession plan in place. The surviving wife, the widow, literally owns 50% of the business, but she has absolutely no knowledge or experience or even physical capability of doing the job. So what happened? The living owner, after receiving a lawsuit from the widow, had to shut down the business, declare bankruptcy, and sell everything off for 10 cents on the dollar in order to liquidate the business and pay her half of whatever proceeds could be generated. So this was a business that was generating maybe $1 million a year in revenue, and now it's making nothing. So some significant changes may be on the horizon in the future as our nation grapples with federal debt and the pressures of these entitlement programs. So investors would be well served to keep a close eye on how these changes will impact their personal finances. The best preparation is to consult with a financial advisor or tax professional who can offer some perspective on your specific financial and tax situation, help you understand the risk, and position your assets accordingly. The markets and the regulatory environments are always changing. In uncertain times like these, sound financial advice should be at the foundation of any long-term strategy. Lastly, just spend 1 or 2 minutes on the important aspects of business succession. So I'm just going to throw a couple of slides up here that are in this appendix. And this shows how some key benefits of having a succession plan in place, such as increased current value of the business, financial security in retirement, providing for family members, minimizing taxes and efficiently and effectively transferring wealth. So really a plan can eliminate confusion by setting a clear path for the next steps, reducing discord among family members and providing clear communication around the process and expectations. So here are some other considerations on how to structure the sale, like an asset or stock sale, how much cash up front, how much financing, over how many years will the note be paid and at what interest rate, and will previous owners stay on in some capacity, or is there any type of an earn-out clause? In this arrangement, the seller finances the business and the seller's payment is based on the earnings of the business over a period of years. So note payments can provide income in retirement to previous owners, so intentionally drafted, as we heard this phrase, to be defective for income tax purposes as a grantor trust. Business owners create an irrevocable trust for the benefit of family members, and the trust is drafted to qualify as a grantor trust for income tax purposes. The grantor-owner transfers property, closely held stock, LLC membership, interest, etc., to the what they call IDGT, and this can which can then purchase an interest in the family business in exchange for a promissory note. So here's another popular ownership through a family limited partnership, or an employee stock ownership plan. This can create a market for closely held stock within the company. So it not only provides important retirement benefits for employees, it also creates a market for the company's closely held stock. And an ESOP is really nothing more than an ERISA plan where employees gain partial ownership of the company as employer stock is contributed to participant accounts. So here's a diagram of a leveraged ESOP arrangement for a closely held business. And note that when employees separate from service, the ESOP trust will purchase the closely held stock back from them at current fair market value for cash. So thank you very much for hanging in there. I know we've covered a lot. And just to make it a little bit easier for you to keep track of all this, I'll show you. This is my website at BryantSikorsky.com. And if you look over here on the upper right-hand corner where you see Facebook, LinkedIn, Twitter, and YouTube, I've recorded this webinar, and probably tomorrow I will upload it to my YouTube channel. So if you just click on that little YouTube icon, you'll see it'll take you to my YouTube channel here. Click on videos, and this shows you all the different webinars that I've done over the last several years. And tomorrow, probably tomorrow, the one you just participated in will show up right here. So with that, I'll say thank you very much for your kind attention, and I hope you have a great rest of your evening. And if you need to reach me for any reason, you can contact me directly, Bryant Sikorsky at 919-650-1527. Thanks so much.